Hello everyone and welcome back. In this video I want to talk about Ferrari because the stock is just going down and down and down. Maybe it is getting cheap right now. Ferrari is known to be a quality stock, a quality company, and as you can see here from this chart at the right, the stock is down more than 30% from all-time highs. I can also show you on Fiscal AI that depending on the stock you're looking at, depending on the stock exchange, the stock is down here more than 35%. And we have the largest drawdown ever since the company went public in 2016, so 10 years ago. Is this normal? Is this because of a particular reason? This is what we are going to talk about in this video. Is this a buy after all? Because you don't get many opportunities to buy Ferrari at a fair price. So in this video, we will talk about the fundamentals of the business and we will see the valuation and whether I will buy or not. And if I am not buying, I will give you my target price. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And my goal is really clear. I want to invest in quality companies when you have these kind of drawdowns. So of course I'm interested. I made several videos on my channel about Ferrari. You can check them out when they uploaded their guidance. But Ferrari is a company that has a huge moat. Ferrari is an inflation hedge. They can price whatever they want for their luxury cars. They have the best customers that will pay whatever prices for this access to these brand cars, luxury cars. You will have 2 years of backlog, cars that are already sold, a waiting list that is huge. Ferrari doesn't want to build more cars, so it's all about demand. And Ferrari is managing the supply tightly so they can have whatever margins they want. So for a car company, the margins are ridiculous. The gross margins are above 50%, net margins of 22%, and sustained high margins, something you don't see for other car makers. So the first point I want to make in this video is very clear. Ferrari is not like other car companies because of the brand, because of the luxury aspect the company has. If you look at the track record, the revenue is up and to the right. Everything has accelerated since COVID. The net income is going up and to the right. The company has a net debt of $1 billion, $1.5 billion. And every year, the company is generating roughly $1 billion. So the company doesn't have a debt problem. And you have a lot of efficiency. As you can see here, the ROIC, return on invested capital, is roughly 20%. So after all the metrics are pointing to the right direction. No major dilution, no major buybacks. So why is the stock going down? Well, let me introduce to you the concept of valuation and let me talk about the track record of the company. Because in the past, after COVID, the company changed a little bit and they went to build more electric vehicles. So they had a guidance and they announced plans to make electric cars. And a few months ago, they changed their plans. They moved away from electric vehicles, went back to their roots, and they updated their profile in the future. Let me show you this. No, net debt, no. This is in their Capital Market Day from October 2025 that we covered on this YouTube channel. They announced some plans and I want to start talking about valuation by this point because this is the starting point after all. So let me scroll down a little bit. You have 100 slides, but nothing is really important here. And you have exclusivity. You all know Ferrari. This is what you have. So for 2030, they want 3 kind of companies. 40% of their cars are normal cars, 40% are hybrid, and 20% is electric. It was not the case a couple of months ago. You had a higher percentage for electric vehicles, Okay, so a change in guidance. Okay, first point about guidance. Second point about guidance, if you scroll down, you scroll down, you scroll down, they talk about brand, exclusivity. Nothing is changing for the business. So I will not talk about this on this video. The average age for their client is 50 years old. We are not talking about youngsters that just got money. We are talking about wealthy people, the best kind of customers you can have. They don't care. They buy one car, two cars, three cars. Most customers are already Ferrari owners. They just want a second car, or they want a spare part, or they just want an upgrade. And if you scroll down through these slides, I will give you the reason why the stock is down. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. At the slide number 99, you have this. Let me put full screen so everybody sees really well. Business visibility, sustaining consistent growth over the longer term. This is their revenue for 2024, 7 billion euros. This is their revenue for 2025, roughly 7 billion euros. And this is their 2030 guidance. They expect revenues to be at 9 billion euros. Well, some people are very smart. Some people calculated the CAGR, the growth rate. And the growth rate, if you go from 7 to 9 in 5 years, it's roughly 6-7%. It's not a lot. It's not a lot at all, actually. For a quality company with pricing power, growing 6-7% is not interesting at all. So this guidance spooked investors. Second line you have is about margins. They expect to grow their EBITDA, adjusted EBITDA margins from 38 to 40. Fair enough. Adjusted operating profits from 29 to 30. Fair enough. So small improvements for a long duration of 5 years. People expected better. So you have a little bit of buybacks here. So the earnings per share are expected to grow from 9 to 11. And this is your free cash flow. This is the cumulative free cash flow. So actually they are cheating here. The way they speak to investors is like for ASML, which I don't like actually. They don't compare apples to apples. So sometimes they talk about free cash flow. Sometimes when they want to look good, they talk about cumulative free cash flow. And a lot of people don't know how to read this, or they read too fast and they get seduced by crazy numbers, which is not honest in my opinion. So anyway, they mentioned their free cash flow. What spooked investors, it's the growth rate of 6%. If you look at the past, you look at the past growth rate for Ferrari. I can go to Stock Unlock here. Freeform. By the way, you see me navigate between Fiscal AI and Stock Unlock. I highly recommend you use these websites. These are mandatory tools, I would say. If you're not using them, you're losing out on thousands and thousands of dollars and your precious time. So you have discount codes in my description, affiliate links. Click on them, it will get cheaper for you, like 10-15% cheaper. You can try them out without your credit card actually. Just see if you like it for 2 weeks. And if you don't like it, you just don't give them money. But I'm sure you will love it. So, if you look at the past for revenue since inception, revenue for Ferrari has grown at 9% per year. If you look at more recent data, since COVID 2021, we are growing above 10%. And now what the management told us a few months ago is that the growth rate was not going to be 9%, not 14%, but 6%. This is bad. It is really bad. Now we live in a world with inflation, and you may have some tariffs, you may have some increased costs for raw materials. Normally, you would have to expect Ferrari to raise prices of their cars because you don't mess around with volumes, so you mess around with pricing. And what Ferrari's management team is telling us is the pricing power will be good, but not great. And people were not happy at all. And I understand this. You want the revenue to grow 9-10% per year for this quality business. And this is the reason why Ferrari was always trading at a premium valuation. So you have a growth rate of 10%. You are improving the efficiency of the business a little bit. EBIT, operating income, has a growth rate of 17%. Even if you remove this, actually, if you remove spectacular years, let me start from a more reasonable point. Revenue has a growth rate of 10%. Has had a growth rate of 10% since 2017. EBIT, operating income, 13% per year. So that means more margins, more efficiency. Add to this net income. Net income growth of 15% per year. Every year you have a business that is growing the profits by 15% per year. You have a little bit of buybacks, so the earnings per share for this business have grown at 16-17% per year for the past decade. And if you put the maximum date here, late 2024, these numbers are even better. So Ferrari is a superior business model with superior fundamentals, right? The revenue has grown at 10% per year, but the earnings per share, because of the efficiency and small buybacks, EPS is growing 19-20% per year. Wonderful, right? And what the management just guided for is a growth rate of not 9%, but 6%. Disappointing. Really disappointing. So if you look at the valuation for Ferrari, you will see that for the past decade, the company was always trading at a premium valuation. Look at this. Even when they IPO'd and you had many doubts when it spinned off from Fred Chrysler in 2015-16, you had a P/E ratio of 25. It went up almost automatically to 30, dropped to 25, and then back up. And since COVID, we never had a valuation, a P/E ratio below 30. Even in 2022, when everything crashed, the Nasdaq crashed, the US economy entered a recession, the consumer was weak. Even in 2022, given the bear market, the P/E ratio was 35. And it rebounded. It bottomed at 35. It went back up to 50, 55. So now when the company announced their new guidance of growing 6% per year, the stock was trading at a P/E ratio of 47. Would you really pay a P/E ratio of 40 for a business that grows at 6% per year? The answer is no. And it seems like people shared this view. So people sold Ferrari. And if you look at the most recent data, since 2024, the valuation just got down, went down and down and down. And since the guidance with a major crash, I think the stock dropped more than 10% in one day. The stock dropped and dropped and dropped. So we went from a P/E ratio of 45 to now 35. Is it cheap? Not yet. We are back to levels we last saw in June 2022. At the time, the guidance was better. At the time, maybe the growth rate was better. We can check live what the growth rate was like. Okay, fair enough. Last 12 months. Let me show you this so everybody understand really well. Yes, exactly. So in June 2022, in yellow you have the P/E ratio. In blue you have the revenue growth rate. At the time, the revenue, not the earnings per share, right? The revenue was growing 17% per year. And then 17%, and then in 2024, 2025, we went back to 11% and now 9%, and they just guided for 6%. So a clear deceleration in revenue. Is this warranted? How low can it go? That's the question that everybody wants to answer. I would say I will not touch Ferrari at a P/E ratio of 35. If it drops to a P/E ratio of 30, it might get pretty interesting because eventually the business will never be trading at a P/E ratio of 20. Given the new era of inflation we enter, given the price pricing power they have, they will almost never decrease their margins. It will be very, very unlikely margins go down. For gross margins, for operating margins that are just going up and up and up, as we said before, the business got more efficient and more efficient and more efficient. And if the revenue is 6%, has a floor of 6%, you can maybe play it around with efficiency. Yes, the revenue growth will be 6%, but if you increase your margins a little bit, your EBIT growth rate may be 10%. If you play around with some buybacks, the earnings per share may be at 11%. So it's a safe company, quality company, but the growth rate is not here. So on a base case scenario, what? The earnings per share will grow at 11% per year. You don't want to overpay for a business growing earnings per share at 11% per year. But actually, a fair price may be okay. So I also want to share with you something, because the guidance can move. In the latest earnings report, they had some slides and they increased their guidance a little bit. What I want to say is the guidance is not stable. They can increase the guidance in the future. Maybe they will slightly increase the guidance from a growth rate of 6% to 8%. If the revenue grows by 8% per year, you have a little bit of more efficiency, improvement in margins. Maybe the earnings per share can grow at 12-13% per year for a sustained period of time, at least 5 years, I would say. So if you have all these estimates, you can use stock unlock, you can use the DCF, and you can forecast. What are your assumptions given everything that we've said? If we want to forecast the next 5 years, we think the free cash flow will grow at, let's use our base case of, it's, let's say 10% per year. Same thing for earnings. We will use a price to free cash flow of 30. And we don't care about dividends. And we will put a buyback program of 1% per year. Maybe it will be roughly 1%. They have a small dividend yield of 1%. And they did some small, tiny buybacks between 0 and 1%. Okay, let's put a 1% buyback yield. So, growth rate of 10% per year. Price to free cash flow of 30. Buyback of 1% of your shares. If these are your estimates, then the stock is overvalued by 16%. Okay? Now the stock is trading at a price of 300 euros. It's euros or dollars. Now the stock price is trading at $340. And the fair value, if these are your estimates, the fair value is something below $300. So it needs to drop a little bit. If you buy right now, if you buy today, if you think Ferrari is cheap, and these are your assumptions, then if you buy right now, your annual return will be 6% per year. Do you want to invest in something that will make you 6% per year? I don't think so. Okay? So if this is my base case actually, so I am not buying Ferrari. What is my good target price for Ferrari? I would say you need to drop below this level to $190. And I would be even greedy and let it drop a little bit more. 250, 260, I might be interested. Now, if you think the guidance will be increased a little bit, instead of growing the free cash flow at 10% per year, you grow at 12% per year. If these are your bullish assumptions, then the stock is still overvalued by 8%. The fair value is $315. And if you buy right now, you can expect a CAGR of 8% per year. Even if you are a little bit bullish, you make 8% per year. I mean, I don't like it at all. So I will not touch Ferrari. I want it to drop 15%, 20%, 25% again. We are experiencing the largest drawdown for the company. I think it can continue to go down. Because why would you pay an expensive price for decelerating revenues like this. You have a quality brand that is known for increasing their prices however they want, and they don't do it. So plenty of questions. You have questions for the management team, you have questions for electric cars, but the big question mark is the revenue growth. What about your guidance? So I will monitor Ferrari. In case they issue some spectacular earnings, they shock the world and they increase their 5-year plan and their guidance, until then, I'm just not buying. Monitoring the situation, but not buying. I hope this video was helpful to you. See you tomorrow. Bye-bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.